Wall Street just bought your grocery store. Wait, how did it jump? The total on the checkout screen flips mid-scan. The clerk shrugs. Prices change hourly now. A loaf of bread, a sack of flour, a box of cereal. Each clicks up a few cents before the receipt prints. Someone behind sighs, puts back eggs. Meanwhile, a steel door seals shut on a seed vault. Barcodes on envelopes read like patents, not plants. The price didn't start in this store. It started upstream, in a contract clause tied to a gene, for firms control most commercial seeds. Financiers set terms before grain leaves the farm. Follow the money from trait patent to your receipt. The grocery bill that started upstream. On a Tuesday in March, the Garcia family pushes the same cart down the same aisles they've used for years. Tortillas, rice, beans, eggs, milk, chicken thighs, apples, lettuce, cereal. The scanner doesn't care about habit. Last year this basket was $142. Today it rings $168. Same brands, same sizes, no splurges. 18% isn't a rounding error. It's a rent coming due. To see where the rent began, trace one item backward. Flour tortillas start with wheat. Wheat starts with a seed. That seed isn't just biology anymore. It's licensed intellectual property. A farmer in Kansas plants a variety with a package of traits. He doesn't own the seed the way his grandfather did. He licenses it for a single season under terms that forbid saving next year's seed. He pays a premium because the seed promises yield stability and herbicide compatibility. He signs a technology use agreement that allows audits. The clause sits quietly in his file cabinet. It will show up on your receipt. But the seed is just the first turn of the ratchet. Inputs follow. That wheat field needs fertilizer, largely derived from natural gas, priced in a global market that swings on geopolitics. It needs chemicals, sold by the same few firms that own much of the seed portfolio. The prices for those inputs are set in long contracts and revised when energy spikes. And when interest rates climb, the financing cost to carry them climbs too. The farm's break-even moves up, not by pennies, by dollars per acre. Harvest doesn't end the price story. A grain buyer posts a cash bid at the elevator. That bid isn't a guess. It's the futures price on the board minus the local basis, plus any premiums for quality. The futures price reflects global money flows. The basis reflects bottlenecks, rail congestion, barge water levels, export lineups. When rivers run low or war closes a sea lane, the basis widens. The farmer gets less relative to futures. To survive, he stores and hedges. More fees, more margin calls, more interest. Those costs don't evaporate. They ride the grain downstream. A processor buys the wheat, mills it, and passes along a price built on procurement, energy, labor, and risk. The mill's contract might include a value-based component, a royalty tied to protein content linked back to the seed's trait. It's legal, standard in some categories, and invisible to shoppers. The brand that buys flour doesn't just pay for white powder in a bag. It pays a stack of embedded obligations. Packaging resin prices rose with oil. Freight rates jumped with diesel and driver shortages. The warehouse slot costs more after private equity rolled up cold storage and logistics hubs. Every step adds a small spread to protect margin. By the time the tortillas hit the shelf, the retailer has already negotiated slotting fees and resets with the category captain, usually the dominant brand. Private label sits next to it, made by many of the same processors, but priced to anchor the aisle. The store juggles shrinkflation, promotions, and weekly ad budgets to keep traffic, not to lower your total. When the invoice from the distributor includes a fuel surcharge and a volatility adjustment, the store manager nudges the shelf tag. The adjustment lands in your kitchen. So where are the choke points? Start with seed IP. Once traits are bundled and locked to specific chemistries, switching costs spike. A farmer who wants to leave the platform risks yield and market access. Grain merchandising is another choke. ABC firms, ADM, Bunge, Cargill, Dreyfus, plus a few newer giants control the nodes where crops become commodities with passports. They control elevation, storage, and export timing. Freight is a third choke. Railcars are finite. Barges wait on water. Containers chase higher-paying lanes. A bottleneck isn't just a line, it's leverage. Then there's the futures market, the reference everyone uses. After 200, index funds and passive commodities poured in. The goal wasn't to corner grain, it was to diversify portfolios. But the effect was real. More money tracking the curve, more volatility when macro shocks hit. When volatility rises, participants demand more premium to take risk. Grain merchants widen spreads. Processors add surcharges. Brands hedge, and then price to the worst week. Retailers stop eating, increases and pass them through. The volatility tax is a line you never see. Let's ground it in one choice the Garcias made. They switched from a national cereal to the store brand. It saved $1.20. But the wheat, corn, and sugar in both boxes came from processors facing the same upstream realities. The store brand contracted later, at a higher basis, but cut the box by 2 ounces. The family saved today and paid tomorrow, paying in more trips and less satiety. There's a human ledger behind each line item. A farmer in Iowa sells grain to make a note payment set when rates were low. Now the interest bites. A miller in Kansas adds a night shift because orders bunch when a barge backlog clears. A grocer in Phoenix drops the end cap promotion because the brand won't fund it this quarter. None of them set the gene price, the pipeline toll, or the benchmark volatility. They adapt around them. To understand why seeds became assets with royalties that echo through mills and brands and into your cart, we need to go back 40 years, to the moment when biology met finance, and a handful of companies learned that patents could set prices for dinner. The great consolidation of seeds. To understand how a clause in a seed contract reaches a family's receipt, we need the map of who owns the seeds. 40 years ago, there were dozens of regional breeders, co-ops, and public programs releasing varieties farmers could save and trade. By the late 199s, a new idea took root: treat seeds like software. Patents on traits turned biology into assets, and the buying began. In the late 198s through the 200s, 6 names came to dominate farm inputs: Monsanto, Bayer, DuPont, Dow, Syngenta, and BASF. They called it synergy, traits plus chemicals under one roof. It looked like a race for innovation, but the fastest gains were on paper. Between 1985 and 200, those firms acquired most of the small and mid-sized biotech shops doing early research. Each purchase wasn't just labs and people. It was a wall of intellectual property that competitors now had to license or go around. Why consolidate? Biotech wasn't cheap. Developing a trait and steering it through trials and regulators cost hundreds of millions over years. A single delay could sink a smaller breeder. Patents created defensive moats, and regulatory data became another. If you controlled the dossiers regulators relied on, you controlled time. Time in seasonal agriculture is power. So the big firms combined scale, patents, and regulatory expertise into a machine that could roll traits into multiple crops and geographies. The 200 ones pushed it further. Dow and DuPont merged their agriculture businesses and later spun off Corteva. A Chinese state firm, ChemChina, bid for Syngenta to secure a pipeline and global reach. Bayer, a German giant, offered $66 billion for Monsanto, the archetype of trait-driven seeds. Competition authorities in the US, EU, and Brazil asked hard questions. They forced divestitures, portfolios of seeds and chemicals sold off to preserve competition. It was the largest negotiated sell-off of AG assets in US merger history. But after the dust settled, the field didn't look wider. The Big Six compressed to the Big Four, with BASF picking up divested lines and joining the front rank. For farmers, the switch flipped slowly. Choice on a seed guide still looked broad, page after page of varieties. But many carried the same trait stacks licensed from the same owners. A corn number from one brand, and a sibling from another traced back to shared genetics and identical herbicide tolerances. You could change the bag, keep the platform. Leaving the platform was the costly move. There's a story seed people tell in private. An independent breeder who'd spent decades crossing regionally adapted lines watched lawsuits eat his margins. Not because his seed failed, but because navigating patent claims and substantial equivalence rules required lawyers he couldn't afford. He sold, not for lab equipment or greenhouses. Those came later, but for the right to keep working without fear that a stray gene would land him in court. Consolidation wasn't only about science. It was about legal stamina. Meanwhile, public germplasm, decades of taxpayer-funded breeding, flowed into private stacks through licenses. Universities needed funding. Companies needed diverse genetics to carry patented traits. The deals often came with exclusivity by region or crop, narrowing the set of alternatives available to farmers in specific counties. On paper, competition existed. On the ground, One or two choices made sense for a given herbicide program and elevator requirement. The business model followed pharma's playbook. Seed firms priced like they had a pipeline. Early traits earned premiums. New trait stacks layered on top, justified by yield ceilings and pest control. When a pest evolved or a weed resisted, a new stack stepped in at a higher tier. Compatibility became lock-in. If your sprayer, your agronomist's plan, and your neighbor's field all assumed a certain chemistry, switching wasn't a single decision, it was a season's risk. Antitrust remedies trimmed overlaps, vegetable lines here, cotton traits there, but left the structure intact. Regulators protected narrow product markets. The companies kept vertical control. Traits, seed production, chemical packages, and distribution aligned under fewer banners. Farmers faced higher switching costs, and the enforcement didn't change the fact that 5 became 4 without shrinking share. The numbers told the quiet part. The dominant firms controlled large shares of commercial seeds and crop protection, and their patents covered the traits that mattered in major crops. In that world, list prices rose in stair-steps that matched trade introductions, not necessarily farmer profits. When energy spiked or input financing tightened, there wasn't a competitor ready with a comparable but cheaper stack. There was a waiting list. Consolidation also pushed enforcement downstream. Technology use agreements expanded. Audits checked seed saving and brown bagging. Investigators sampled fields to ensure trait licenses were paid. The chilling effect wasn't a headline. It was a farmer deciding not to experiment on 40 acres because a neighbor got a letter over pollen drift. Here's the thread back to the Garcia's tortillas. When a few firms control the traits embedded in most of the wheat, corn, and soy that feed processing plants, they can set pricing ladders upstream. They don't set retail tags, but they set floors through royalties and technology fees, and they set ceilings through compatibility. A processor trying to avoid those stacks risks supply reliability, regulatory friction, and agronomic headaches. Most don't. Consolidation made seeds scarce in a specific way. Scarce as independent options. Finance turned that scarcity into a product, predictable, modulable, and priced into every link of the chain. The clause that began in a seed agreement could now ride along, invisible and enforceable, all the way to a family checkout. Patents changed who had power. In the next turn of the story, derivatives would change how that power moved prices day to day. Patents, traits, and the subscription farm. The old deal was simple. Buy a bag, plant it, and if the harvest was good, save some for next year. The new deal reads like software. A farmer signs a technology use agreement that grants a one-season license to plant. No saving seed, no replanting from harvested grain, no resale outside approved channels. The bag is a vessel. The value is in the patented traits inside. The contract follows the gene, not the farmer's barn. Here's where the model shifts from ownership to subscription. Each spring starts with a renewal, new seed, new fee, new bundle. The bundle is the point. Traits arrive stacked. Insect resistance plus herbicide tolerance plus stress resilience. The stack isn't just science, it's a gate. The herbicide tolerance ties you to a chemical program, and that program is sold by the same company, or its closest partner. Compatibility becomes a business strategy. Your sprayer tips, the timing of applications, and even the neighbor's plan nudge you to stay on the platform to avoid drift conflicts and yield surprises. Prices climb a ladder set by yield zones. In higher yield counties, the list price for the same genetic base carries a bigger premium. It's not just about gains, it's about avoiding losses. Farmers pay to reduce risk, less stand loss after an early pest, more control over late-season weeds, fewer unknowns when weather turns. That risk avoidance is billable, so the price sheets scale with what a field could produce at the top end. The effect is subtle. The better your ground, the more the platform can charge for keeping it predictable. Enforcement isn't theory. Audits happen. Field scouts test for traits in harvested grain to verify licenses were paid. Seed cleaners that once serviced saved seed face compliance checks or exit the business. Lawsuits land, and even when they're rare, the letters travel fast. The message is clear. Independence has a legal cost, and the only safe path is inside the stack. Farmers who want to run side-by-sides with off-platform genetics think twice. A stray kernel with a patented trait in a bin can become a headache. Meanwhile, a parallel contract appears at the elevator and processor, value-based licensing. If a trait improves milling yield, protein consistency, or oil content, a royalty can attach to the quality premium. The mill pays a few cents more per bushel tied to that trait's performance. It sounds fair, pay for value delivered. But once it's embedded, that royalty compounds. The processor builds it into flour costs, the baker builds it into dough, the brand into the SKU, the retailer into the shelf tag. A trait fee set upstream becomes a small surcharge on millions of loaves. On paper, farmers retain choices, conventional. Seed, public varieties, off-patent genetics. In practice, access narrows. Local dealers stock what moves. Crop insurance discounts and lender comfort align with the dominant packages. Elevators offer premiums for certain trait-linked qualities and shrug at others. A farmer chasing a better margin through alternative genetics must secure chemistry, cleaning, storage, and a buyer willing to segregate. That's a full-time job on top of farming. There's a personal calculus every spring. One farmer in Nebraska runs spreadsheets that would fit on Wall Street. Seed cost per acre, expected trait benefit, herbicide passes, fuel, labor, interest, storage. He's not chasing record yields. He's minimizing downside volatility. The subscription model fits that frame. Pay now to narrow the error bars. Except the error bars elsewhere widened. Diesel rose. Interest doubled. Futures swung harder. The premium for predictability started to swallow the margin it was meant to protect. Stacked traits also changed the landscape of resistance. When a weed survives one chemistry, the next stack offers tolerance to a new mode of action, often at a higher tier. The cycle, resistance, response, price step, turns into a staircase. Most farmers don't want to push that treadmill, but stepping off means a different set of risks. Yield drag with older genetics, a patchwork of generic herbicides with uneven efficacy, and potential conflicts with neighbors still spraying later in the season. Regulators tried to balance innovation with oversight, but the bottleneck isn't approval, it's who holds the keys. The companies price like pharma because they manage like pharma, pipelines, exclusivities, life cycle extensions. A trait that's nearing patent expiration finds new life bundled with a fresh companion, keeping the package protected. And because the value is in the bundle, not the single gene, the expiration clock matters less than the platform's momentum in the market. There's a quiet effect on research. Public breeders still release lines, and small firms still innovate, especially in specialty crops and regions. But licensing terms can contain non-compete zones and exclusivities that carve the map. A drought-tolerant line adapted for one river basin might be locked to a single distributor, leaving nearby counties with inferior options or higher prices. The genetic diversity might exist, but the contractual diversity doesn't. From the Garcia's perspective, none of this sounds like it should touch a grocery bill. Yet the subscription farm ripples into contracts at mills, bakeries, and brands. When inputs become licenses with enforcement teeth, cost variability shifts upstream into fixed fees. Companies pass fixed fees forward more efficiently than they pass windfalls back. A few cents on a bushel at the value-based royalty stage becomes a few cents on a pound of flour, then a few cents on a loaf. In a market already tuned by consolidation, those cents don't compete away. They accumulate. Patents change power. They didn't just reward discovery. They set the rules of engagement for every season that followed. And in a world where risk feels bigger, whether geopolitics, interest rates, the subscription farm sells certainty at a premium. The bill lands where it always does, at checkout. Derivatives will decide what that number reads on any given Tuesday. Futures, basis, and the invisible surcharge. To see how derivatives change the number on a Tuesday, start with a screen no shopper sees, the futures board. Chicago lists wheat, corn, soy, standard contracts for standard months. That price is the world's reference. But nobody delivers from your county to the pits. Cash trades use the board as a starting point and then adjust for reality. That adjustment has a name, basis. Basis is the local truth. It's the cash bid minus the futures price, and it moves with rail schedules, river levels, export programs, elevator space, and weather. When everything runs smooth, basis sits within a narrow band people expect. When the Mississippi drops, barges lighten loads, queues grow, and basis blows out. The number on a farmer's check shrinks versus the board. The elevator pays less or hits storage limits and posts weaker bids. Risk doesn't vanish, it shifts. The farmer hedges on futures to lock a price, but a hedge brings margin calls when markets swing. That's collateral the farmer has to wire, sometimes by noon. In a calm year, it's manageable. In a volatile year, the calls come like storms. A grower sells cash grain, but if the futures leg runs against him before settlement, cash flow gets squeezed right when fuel and fertilizer bills hit. He draws on an operating line to meet margin and waits for the hedge to net out later. Interest quietly joins the cost of grain. Meanwhile, the elevator is hedging every bushel too. It buys local, sells futures, and earns a spread for carrying grain and making delivery later. When volatility spikes, its brokers demand more margin. Elevators raise service fees, widen their bids, or require farmers to price faster. If they finance longer carries, they pass the cost to the next buyer. Everyone pays a premium to keep the machine from seizing. That premium becomes the invisible surcharge. After the 200s, a new player amplified the swings: passive money. Index funds and commodity ETFs didn't want grain, they wanted exposure. Pension funds sought diversification. Approvals came, and billions flowed into long-only commodity baskets. On paper, they just rolled contracts month to month. In practice, roll weeks became crowded. Spreads moved. Commercials adjusted. When macro fear hit, financial crises, pandemics, wars, money rushed in or out together, exaggerating price moves. Volatility widened. Basis followed. A miller doesn't trade for sport. They hedge flour costs to protect a bakery's quarterly budget, but hedges aren't free. Banks set credit lines against worst-case moves. Risk managers price to the ugliest week they've seen in recent memory. So when headline prices spike for 2 months and drift down later, the retail shelf rarely drifts down as fast. Contracts reset on the high. The surcharge sticks longer than the shock. There's a human moment in the middle of all this. A grain merchandiser in St. Louis answers his phone at 5:12 a.m. The overnight board gapped lower on a rumor about a ceasefire corridor. His river terminal is still short barge capacity, and his bins are full. Farmers want to deliver. He drops the cash bid by more than the board because basis is already strained. He hates it. He also has margin to meet before the bell. He taps the line, calls the barge scheduler, and eats a granola bar at his desk. By lunch, a hedge fund note pushes the board higher again. Basis doesn't snap back. The phone keeps ringing. Farmers feel it season by season. They plan sales across months to average a price, only to watch a basis swing erase the careful timing. Some invest in on-farm bins to gain leverage, sell later, avoid harvest gluts. Bins help, but they bring debt, insurance, maintenance, and shrink. And storing grain turns farmers into their own elevator, with the same exposure to margin if they hedge. The finance cost of patience is another line item. Processors try to standardize the chaos. They buy forward, they spread deliveries across origins, they hedge across months. But freight can fail. A low river moves a unit train from arriving to unknown. Diesel spikes. A strike threatens a port. Each hiccup widens the risk band, which widens the premium they require to guarantee supply. That premium folds into flour, oil, meal, cereal. A brand manager sees the supplier letter, temporary volatility adjustment, and starts a pricing workflow. Consumers don't see basis on a shelf tag. They see new size and a few cents more. Yet the pattern appears if you look. Regional price bumps after a barge jam, coastal jumps after export surges, inland discounts when rail frees up. A week later, a national promotion ends early because the forward curve shifted. The math behind it links directly to futures and basis. The cash register reflects both. There's a story mills tell about the summer the river ran like a creek. Basis went so wide that local cash bids looked broken. Farmers who hadn't pre-sold held back. Elevators posted storage by appointment. A flour customer asked why their price moved when the futures chart on TV showed a dip. The answer was short: we buy reality, not TV. The customer didn't like it. They still paid. Derivatives didn't invent scarcity. They priced it, instantly and publicly. In calm times, that transparency helps. In storms, it transmits panic faster than trucks can move grain. The system protects its participants by charging more to carry risk. Those charges travel. The board blinks red, the basis groans, the invoices adjust, the shelf tags follow. And even when the board calms down, the memory of pain keeps premiums alive. That memory is part of your receipt. Grain silos to data silos, logistics as leverage. While the board blinked and basis groaned, something quieter shaped price. Control of the choke points that move grain from field to fork. For a century, grain silos were the leverage. Today, it's silos plus software. Start with the companies that run the arteries. ADM, Bunge, Cargill, and Dreyfus, the ABCDs, sit at the nodes. Country elevators crush plants, export terminals, barge fleets, rail unit train loaders. Add Glencore, now Viterra, and a few regionals with muscle. If you want to move grain at scale, you'll meet them. They don't just buy, they schedule. In logistics, a calendar can set a price. At the country level, the elevator's posted bid hides a second decision: space. Space is power. During harvest, bins fill, trains must be spotted, barges must be booked. If an elevator knows a shuttle train is late and barge drafts are cut, it lowers bids to slow deliveries. Farmers push back with on-farm storage, but the elevator still controls the outlet. A penny here, a nickel there, multiplied by volume and time, becomes real money. Go downstream to export. A Gulf terminal with 3 berths and a line of Panamax vessels can dictate origin timing. If a charter sits idle, demurrage fees stack. To avoid them, a merchandiser pays up to pull grain forward, widening basis inland. If a rival's terminal is down for maintenance, the open terminal captures premiums. That's not speculation, it's a toll on a bottleneck. Rail and barge are the gears between. Unit trains require committed volumes, service agreements, and priority windows. Miss a window, and your train loses slotting. Pay a penalty, or wait. On rivers, a dry spell forces lighter loads and more trips. Towboats face locks that slow traffic for hours. Every constraint is a chance to reprice risk. The companies that own or lease the most capacity can shuffle cargo and customers to preserve their margin. Everyone else pays to adapt. A day in the life makes it plain. Mara runs a mid-river elevator with 4 pits and not enough space. At 6:10 a.m., her dashboard lights up. AIS shows a tow delayed 2 locks north. Her unit train ETA slips by 8 hours. The forecast drops river stage another inch by Friday. She lowers the posted bid 3 cents to slow inbound loads and pings 3 farmers through the app to push deliveries to Saturday. Small favors she'll repay with a trucking credit next week. By 9:30, 5 trucks idle at the scale. She opens only 2 pits to stretch line time, buys herself an hour, and calls the barge broker to swap into a shorter draft tow at a higher fee. At lunch, corporate's pricing model suggests a 2-cent throughput management fee for the afternoon. She adds it. By 3 p.m., the train delay cements. Mara closes new spot contracts for tomorrow to keep space for forward-sold grain that carries penalties if she refuses it. No one thing feels like a gouge. Every click is a response to a clock she doesn't control, guided by a dashboard the company does. Here's where data remakes leverage. The giants don't just see grain, they see flows before they happen. They run farmer portals, origination apps, satellite crop models, barge AIS feeds, rail telemetry, and weather ensembles. They stitch them into dashboards that predict when and where grain will move, what quality will show up, and which bottlenecks will pinch first. Timing beats posted prices. If you can forecast a surge into your terminal on Thursday, you cut bids on Wednesday and raise service fees by Friday. You aren't breaking a rule, you're managing congestion for profit. Meanwhile, regulators can cap list price increases at retail or scold brands for shrinking boxes. They can't regulate sequence. If a merchant advances timing by a week across a corridor, the price floor shifts without a headline. The advantage is in clocks and queues, not just quotes. Data turns queues into tradable opportunities. A microstory makes it plain. In late September, rain upriver slowed harvest in the north, while a southern stretch of the Mississippi ran shallow. Barges stacked up at a lock, drafts got cut. Within 3 days, basis in a cluster of Midwestern towns widened by 20 to 30 cents. A regional bakery sourcing flour from mills fed by those towns watched its supplier at a river logistics surcharge. By the following week, the bakery raised loaf prices by 7 cents in a handful of zip codes. Shoppers noticed nothing except that eggs were finally down a bit, while bread bumped up again. A barge backlog had reached a lunchbox. Data also changes how farmers are courted. Originators offer contracts linked to forecasted basis patterns, premium programs keyed to protein windows, and app alerts nudging deliveries into off-peak hours. Useful, yes, but the system learns the farmer's habits. The more predictable a delivery pattern, the easier it is to manage spreads in the merchant's favor. It's a loyalty program with a spreadsheet behind it. Across town from the elevator, a private equity-backed cold storage network signs multi-year deals with processors. Even if your grain isn't refrigerated, your bread is competing for truck slots and warehouse labor with everything else. When a 3PL rolls up regional carriers, access to backhauls and drop trailers turns into a bargaining chip. Freight becomes another gate the giants can open or hold. Control the flow, and you set the floor. What must be paid to pry grain loose when space or time is tight? Control the genes, and you set the ceiling. What can be charged for predictability and compatibility? With silos and software aligned, the space between floor and ceiling belongs to whoever manages the queue best. And that space is where grocery prices live. When basis blows out and freight adds temporary surcharges, those invoices land on processors and brands, and the category captain converts them into planogram tweaks, pack changes, and list moves that show up as shelf prices the next reset. The grocery oligopoly and category management. Control of genes and flows sets the upstream price band. The last mile decides what you see. Over 2 decades, grocery retail consolidated into a handful of national and super-regional chains, with a few mass merchants and club stores sitting on top. This isn't just fewer logos. It's fewer buyers negotiating for most households' dinners. When 3 or 4 players write the calendar, brands fall in line. And when a retailer's earnings lean on merch margin, price becomes a lever, not a signal. Walk the cereal aisle with a buyer's eyes. Every shelf inch is real estate. To live there, brands pay slotting fees, upfront money to get a new SKU into a planogram. Big brands write bigger checks and commit to promotions that guarantee velocity. They also act as category captains, advising retailers on the entire aisle's layout, even where rivals sit. The pitch is data-driven: maximize sales per inch, reduce dead stock. The effect is structural. The captain's incentives shape which products consumers even notice. Category management turns a negotiation into an algorithm. The model blends price elasticity, promotional cadence, and shelf placement into one plan. When upstream costs rise, the captain proposes an optimal pass-through. Small list price moves, strategic pack changes, and promotional frequency tweaks. Retailers accept because the spreadsheet shows margin protection with minimal volume loss. That's where shrinkflation slides in. 82 ounces becomes 76. A family notices only when breakfasts run out early. Private label looks like resistance. In practice, it's alignment. The same processors that make national brands often run the house brand line on Tuesday night. Retailers use private label to anchor price perception. We've got your back, while capturing higher margins per unit. When wheat or corn costs jump, private label acts as shock absorber, but only to a point. The processor's tolls, freight surcharges, and volatility adders sit in both invoices. The store toggles, smaller pack here, promo there, end cap gone. The basket total creeps anyway. Behind the scenes, resets are the power move. Every quarter, a retailer resets categories, pulling low performers, adding new sizes, shifting facings. The captain prepares the plan, assigns facings by projected turns, and proposes co-op spend. A mid-size brand lacking co-op dollars loses a shelf, velocity drops, forecast confirms the cut, and the spiral completes. Consumers choose, but the menu shrank before they arrived. When upstream risk premiums swell, resets accelerate, and the remaining brands synchronize price moves. There's a micro-story from a Midwestern chain. A bakery supplier sent a letter. Flour contracts rolled at a higher basis. Diesel surcharges persist. Add 7 cents per loaf. The chain's merchandising team faced a choice: eat margin or take price. The category captain modeled a split. Raise list by 5 cents, shrink a value pack by 2 slices, and boost private label end caps for 4 weeks to keep trips. The plan protected gross margin and held unit velocity. Customers felt prices are up, but deals still exist. The surcharge embedded across formats. Club and mass add weight. Their volume lets them write longer contracts and demand most favored pricing. Brands backfill margin at traditional grocers. When a club locks a price for 6 months, the brand leans on independent retailers to accept earlier increases and fewer promos. Independents either follow or reframe with local products that can't match scale. In a concentrated retail map, large accounts set national pricing cadence, and the rest surf the wake. Data closes the loop. Loyalty programs record baskets with time stamps. Retail media networks sell targeting inside the app and on the shelf. A brand can raise list price on Wednesday and fund a targeted coupon Thursday to households likely to defect. The headline price climbs. The defection is contained. Category health looks stable. Household budgets quietly ratchet. When the next upstream shock hits, the tactic repeats. Over a year, the step UPS stick. It's tempting to blame the last link for every increase. Retailers feel squeezed too. Labor contracts, refrigeration repairs, shrink, and debt from expansions or buybacks. But concentration gives them tools. They gatekeep categories, monetize access, and time pass-throughs to protect earnings. Upstream finance created a volatility tax. Category management decides who pays today and who pays later. For families like the Garcias, choice in the aisle is real, but bounded by deals made months earlier in rooms they'll never see. Wall Street's quiet entry, private equity and farmland REITs. While category captains tuned the shelf, another force rewired the cost of getting food there. The price of money and who owns the assets. The faces didn't change, same seed brands, same processors, same warehouses, but the owners behind the logos did. Wall Street didn't arrive with ads. It arrived with term sheets. Start with the quiet role UPS. Private equity funds bought input distributors, regional processors, grain handling clusters, cold storage, and third-party logistics. The pitch to investors was simple: stable volume, fragmented markets, room for professionalization. The play on the ground was leverage. Acquire 3 mills, centralize procurement, close overlapping plants, renegotiate freight, and add debt. Debt demands a yield. Price becomes the dial. A fertilizer blender that once haggled on price with farmers becomes a platform that standardizes margins. A cold storage operator adds fees that used to be a handshake. A regional grain warehouse switches from net 30 to net 10 with a discount, pushing suppliers to borrow or accept less. Each tweak is small. Across a roll-up, those tweaks meet a quarterly coupon. The cost of capital turns into surcharges and tighter terms, then into higher processor and brand prices. Meanwhile, farmland itself became an asset class. Pension funds and family offices started buying acres. Specialized funds and REITs followed. The pitch was inflation protection and uncorrelated returns. The mechanism was leases. A grower who once owned land now signs a longer lease with escalators and participation clauses, base rent plus a share of crop revenue above a benchmark. In good years, rent climbs with price. In bad years, the base still bites. Sale-leasebacks free cash for farmers today, but lock in higher fixed costs tomorrow. Rent pressure changes planting decisions. A grower facing a bigger fixed nut leans toward crop packages that promise fewer surprises, even if the input bill rises. The subscription farm model fits neatly into a leased world. Predictable outcomes beat chasing bargains. Lenders prefer it, insurers price it, landlords like the paperwork. The result is a higher minimum viable price for grain before anyone talks about brand strategy. A micro moment shows the shift. A family in eastern Washington sells a quarter section to pay off variable rate debt after rates jump. A farmland REIT buys it at a cap rate that pencils in steady rent growth. The REIT's investor deck touts water rights security and tenant quality. The former owners lease back, sign a 5-year with CPI escalators, and add a clause tying a small bonus to protein premiums. On paper, everyone's aligned. In practice, the farmer's operating line now covers a rising rent while protein premiums fluctuate with weather. The stress moves from balance sheet to checkout in the form of firmer flour prices. Private equity also stepped into bottlenecks. Cold storage and ambient warehouses saw waves of deals. After consolidation, access changed. Minimums rose, drop fees appeared, and peak season surcharges hardened. Food manufacturers with perishable goods paid to keep slots. Those fees landed in landed cost spreadsheets, then in price letters to retailers. A logistics manager who once called a local warehouse now negotiates with a national network that can dictate terms by region. When diesel spikes, the surcharge appears in bold and rarely disappears on time. In inputs, roll UPS of crop chemical retailers tightened local competition. A farmer who once sourced from 3 independents now sees 1 banner with 3 outlets. The price board grows uniform, and rebates replace haggling. Terms become policies set by a finance team 2 states away. If a farmer misses a payment, access to early order discounts disappears. Miss early orders, miss price breaks. Miss price breaks, and the crop budget slides. The effect multiplies when interest rates climb. Every actor carrying inventory, inputs, grain, packaging, pays more to hold it. Owners with leverage can't absorb that quietly. Their debt covenants won't allow it. They shorten payment terms, raise storage rates, and charge inventory financing adjustments. Brands confronted with those letters hedge more and stretch pack sizes less. Retailers get cleaner, faster pass-throughs, backed by spreadsheets and covenants they understand. The consumer sees steadier shelves at steadily higher unit prices. There's a second-order shift, governance. Funds seek exits. A processor under private equity ownership eyes an IPO or a sale to a larger player. To hit targets, it focuses on price realization. Promotional depth shrinks. Co-op funds are rationed. Small customers get standardized deals. Category captains downstream adapt to that firmness by smoothing retail moves, not reversing them. The system gains financial discipline while shedding the slack that once cushioned shocks. Farmland funds argue they professionalize stewardship, better irrigation, soil testing, ESG reporting. Some do, but the rent check still clears before harvest risk. When drought hits or a river closes, a leveraged chain tightens, not loosens. Everyone upstream protects their covenants. The farmer pays rent, the processor pays interest, the brand defends margin, and the shopper pays the residual. Finance didn't invent consolidation. It accelerated it and hardened it. By buying land, warehouses, mills, and distributors, financial owners embedded a yield requirement into assets that set the cost of dinner. Higher cost of capital means higher floors for acceptable prices all along the chain. When Wall Street bought the gates, groceries started reflecting a new line item. Return to capital, due monthly, regardless of weather. Seeds as IP portfolios, the patent fund playbook. By the time Wall Street bought warehouses and rails, it had also learned a cleaner play. By the genes. Not the fields, the portfolio. Inside seed companies, traits became assets with cash flow profiles, and the firms started talking in a language investors understood: pipelines, exclusivities, life cycle management, addressable markets. The spreadsheet wasn't asking, does this corn stand well? It was asking, what's the royalty per acre in year 3, and how long until a successor stack extends protection? Treat a seed firm like pharma, and valuation shifts from this season's sales to a decade of trait monetization. Analysts model discovery, regulatory milestones, launch curves, peak acreage, and decline under patent cliffs. The answer justifies paying up in mergers, not for fields or factories, but for dossiers and approvals. When Bayer bid for Monsanto, the math leaned on combining herbicide systems with dominant trait stacks, cross-licensing costs falling, and a pipeline that could spin out new bundles across continents. Regulators forced divestitures, but the core logic remained. Control the IP, control the rent. Universities fed the pipeline. Public germplasm, diverse, regionally adapted, moved under license into private stacks. The license fees funded labs. The exclusivities narrowed choice on the ground. Contracts drew maps. This trade on this crop in this zone through this distributor. Breeders got access. Farmers got fences. The germs of diversity stayed in vaults unless they fit a stack with a path to market. Patent funds and corporate venture arms hovered at the edges. They took minority stakes in biotech startups with a single trait or platform. The pitch read like drug discovery. De-risk in stages, milestone payments tied to field trials, option to acquire if data hits. For the startup, it was oxygen and a runway. For the incumbent, it was a call option on the future and a way to preempt rivals. If the startup's trait threatened an incumbent's stack, the cleanest hedge was to own the option to fold it in. Exclusivity zones did more than block rivals. They shaped regional agronomy. A drought-tolerant line with strong performance in the high plains might be contractually tied to one major's distribution, crowding out older public lines that performed nearly as well at lower cost. Elevators that posted premiums for that trait reinforced the loop. Once processors built quality specs around it, alternative genetics lost buyers even if they existed. The constraint wasn't biology, it was paperwork. Mergers added another premium: regulatory know-how. Approvals in the US, EU, Brazil, and China each require data packages, field trials, and years. Owning a regulatory team and a library of studies is a moat. When ChemChina moved on Syngenta, Part of the logic was importing that approval muscle. When Dow and DuPont combined AG units into Corteva, they pooled data and teams that could push traits through faster and defend them longer. Buyers of these firms weren't just buying seeds, they were buying time. Here's a boardroom microstory. A seed company CFO walks into an investment committee with a slide. Trade X, expected royalty curve. The curve rises for 5 years across corn and soy, plateaus as adoption saturates, then declines as patents near expiration. The next slide overlays trait X plus 1, a stacked successor with a new mode of action. The plateau stretches. The cliff turns into a ramp. The committee nods. Marketing gets a budget. Legal drafts exclusivity terms. M&A scouts smaller labs working on complementary genes. The decision isn't about yield records. It's about smoothing cash flows. On the ground, that curve looks like a spring decision in eastern Nebraska. Jess farms 1,800 acres split between corn and soy. Her dealer quotes a premium for a new stack, $2 more per unit than last year, paired with a chemistry bundle rebate that disappears if she mixes modes from a generic supplier. The pitch isn't higher record yields. It's fewer resprays and cleaner rows, which keeps her custom harvester on schedule and avoids a late fee in a tight labor year. Jess runs the math. Seed and chemistry at $18 per acre. She expects a 3-bushel cushion against wheat escapes and a narrower variance. Her lender likes the predictability. Her landlord prefers tenants on the program. She signs. At harvest, Jess hits the elevator's protein and moisture targets and earns a small premium that her mill later ties to a trait-linked spec. A few cents of that premium routes as a license fee upstream. Jess doesn't see the license line. She sees the net check. The mill sees both. Next spring, the successor stack arrives with a new mode of action and a bundled discount that sunsets the old tier. Jess could step back to older genetics, but the rebate structure, her sprayer's tips, and her neighbor's later spray window make that risky. The portfolio slide in the boardroom becomes Jess's seed sheet, and the royalty curve becomes her per acre cost. Once traits are assets, litigation becomes a revenue defense, not a PR risk. A lawsuit that stops unauthorized use or blocks a biosimilar-like entry protects the curve. Settlements with consent judgments send a message to dealers and cleaners. Compliance audits turn into a recurring function with targets like any sales team. Every enforcement action isn't just a case. It's a signal to credit markets that the moat holds. Processors learn to speak this language too. Value-based licensing attached royalties to measurable outcomes. Oil profile for crush margins, protein windows for milling yield, feed conversion in livestock. Contracts pushed the trait's economics into invoices. Brands saw a line, quality premium, and built it into SRPs. It wasn't a conspiracy, it was alignment. Investors wanted predictability. Traits delivered it in cents per pound. Critics point to lost diversity, regional lock-ins, and higher farm gate costs. The firms point to faster innovation, pest resistance management, and global regulatory compliance. Both can be true. What matters at checkout is how the financial frame turns possibilities into obligations. A patent nearing expiry isn't a discount. It's a trigger for a new bundle. A public line that could thrive finds a gate it can't open without a partner's logo. When weather hits or wars scramble routes, the IP scaffolding creaks in a particular way. Royalty curves don't flex with rain. Debt service doesn't waive for floods. The system protects the pipeline first because the pipeline is the valuation. And the valuation is the reason the acquisitions happened. Upstream, a clause rides a kernel. Downstream, it rides an invoice. In the middle, a portfolio manager marks a model to market and asks a simple question. Are the royalties arriving on time? Droughts, wars, and the price spiral. Weather doesn't read contracts. In 2021, heat domes settled over the northern plains and Pacific Northwest. Wheat shrank, kernels light and thin. Protein rose in some pockets, but test weights fell and yields cracked. The same summer, Western Canada's prairies burned under record highs. Elevators posted quality spreads that punished the light grain and rewarded scarce premium. Farmers hauled fewer bushels per acre, paid more for freight per ton, and watched basis widen as buyers triaged what to take. The pipeline ran, but thin. Then 2022 broke the map. Russia invaded Ukraine, and the Black Sea, one of the world's breadbaskets, turned into a chessboard. Ports stalled. Insurance for cargoes soared. Futures gapped higher on headlines. Basis swung as importers scrambled to replace missing wheat, corn, and sunflower oil. A corridor deal teased relief, then flickered. Every rumor priced instantly. If you milled flour, you hedged deeper. If you baked bread, you pre-bought and prayed shipments held. If you ran a grocery chain, you got letters stamped force majeure and temporary adjustment. Meanwhile, drought didn't blink. The Mississippi dropped to levels that made barge drafts laughable. Grain that should have flowed south piled inland. Rail tried to catch up, but locomotives and crews don't appear on demand. Elevators throttled bids. Farmers stared at bins and spreadsheets. If you could store, you did. If your operating line was full, you sold anyway and ate the discount. Banks extended some grace, but they also raised rates. Margin calls and interest joined diesel on the list of headaches. Insurance cushioned the blows, up to a point. Crop policies paid on revenue shortfalls, but payments lagged harvest. Input bills didn't. Fertilizer invoices dated back to a winter spike in natural gas. Seed and chemistry were bought months earlier, with financing tied to higher base rates. By the time indemnities hit, interest had already nibbled away. Some growers sold equipment to bridge. Others refinanced land, quietly shifting risk into longer leases and higher future rents. The math fixed liquidity today by hardening costs tomorrow. Importers did what they had to. North African and Middle Eastern buyers bid up cargoes to keep bread subsidized at home. Southeast Asia pivoted origins. China toggled between Brazil and the US to fill gaps. Each pivot reverberated. A vessel diverted to India left a US mill short. A crush plant switched soybean runs, tightening meal for feed. Traders made money on the moves. Poultry integrators and dairies swallowed feed surcharges and passed along pennies in eggs and milk. The chain stretched, never broke, and charged for the stretch. Exporters played defense. Governments talked about food security and, in some cases, restricted shipments to keep domestic prices stable. Those moves calmed one audience and rattled another. Futures spiked again. The volatility tax resurfaced with a larger font. Suppliers raised minimum order quantities. Long-dated offers expired faster. Retail buyers, seeing their calendars upended, shortened promotions and boosted private label futures. But they still accepted higher lists when contracts reset. The shelf followed the contracts, not the headlines that later declared prices easing. At home, the lag turned into a lesson. Families saw headlines about grain prices falling back while bread and cereal didn't. The answer sat in the fine print: quarterly and semi-annual resets, baked-in surcharges for freight and risk, and hedges struck at peak. A bakery whose flour contract rolled in July carried the high into fall. When the river finally rose and basis softened, the next roll date was months away. Memory of pain kept everyone wary. Brands were slow to give back out of fear of new shocks. Retailers waited for co-op funds to restore promos. Shoppers adapted with smaller baskets. There was a farm kitchen moment that summer. A grower spread his statements on the table: seed invoices, chemical receipts, diesel logs, hedge account reports. He wasn't ruined. He was tired. He'd made the right calls early, sold some forward, ensured his revenue. But every cushion had a fee. Every fee had a friend: interest. He circled a number at the bottom, net after land rent and debt service, and shook his head. "We did everything right," he told his wife, "and groceries still got more expensive." He wasn't blaming the store. He was staring at a system that monetized every scare. The spiral didn't end with grain. Sunflower oil shortages pushed food processors into soybean and canola. Snack makers rewrote recipes. Fryers ran on blends that priced off whichever oil was least chaotic that week. Restaurant chains introduced market price on items that never carried it. A bottle of cooking oil became a lesson in geopolitics. The Garcias noticed they were buying smaller bottles more often. The per-ounce price advanced quietly. By late 2023, the board looked calmer. Cargoes moved, corridors reopened, drought maps faded in some regions. But the structure had shifted. Longer contracts referenced broader risk bands. Suppliers negotiated clauses that allowed midterm surcharges when logistics flashed red. Lenders kept higher margins on operating lines. Landlords didn't lower rents. Leases had escalators baked in. Seed and trait bundles didn't get cheaper. New stacks arrived on schedule. The premiums that surged in crisis found permanent homes in paperwork. This is how a shock hardens into habit. Droughts and wars arrived like storms. They left behind new baselines, guarded by contracts and justified by recent memory. Each actor passed along a sliver of protection. The final pass happens at a scanner that doesn't know why bread costs more. It just knows the system already decided it must. Antitrust, labeling, and the limits of regulation. Policy tried to catch up after the shocks, but it arrived with dull tools. Antitrust enforcers looked at the seed and chemical giants and saw overlaps they could trim, not a system they could unwind. So mergers were approved with remedies. Divest this vegetable line, sell that herbicide portfolio, license a trait to a rival. The press releases sounded firm. On the ground, the new owners slotted into the same playbook. 5 became 4. The portfolios got cleaner. The royalty curve stayed intact. In Washington and Brussels, the cases focused on product markets, cotton traits here, canola hybrids there, because that's how the rules are written. Vertical power across patents, inputs, and distribution remained largely out of scope. Enforcers could stop the same gene from sitting in 2 hands. They couldn't easily stop one company from owning the trait, the chemical, the data platform, and preferred access to elevators. Structural separation would have meant breaking integrated stacks. Regulators weren't ready, and courts tend to ask for proof of harm in a narrow lane, not a map of leverage across a chain. A farmer in Nebraska read the consent decree summaries and shrugged. His seed dealer changed brands on a few pages. The price ladders didn't move. The elevator still paid for protein linked to a single trait. The crop protection rebates still required a minimum bundle. He wasn't anti-antitrust. He just knew the remedies were designed for a simpler market than the one he lived in. Consumers pinned hopes on labels. If you can't unmake the stacks, at least reveal them. The GMO fight became the stage. Europe mandated labels, Japan too. In the US, after state skirmishes, Congress settled on a national disclosure standard, text, symbol, or a QR code. Transparency felt like a win. The effect was Messier. Many processors reformulated in Europe to avoid labels. In the US, disclosure often hid behind a digital link. Surveys said shoppers distrusted GMOs. Scanner data said price and convenience still ruled. Shelf space didn't become a referendum on upstream control. Labeling also created new costs, segregation, audits, reformulation, that larger firms handled better than small ones. Those costs flowed into prices or into fewer SKUs. And labels didn't touch the royalty clause in a mill contract or the volatility adjustment in a freight invoice. The gene could be disclosed on a package and still collect a fee 3 steps upstream. Information didn't equal negotiation power. Another policy front opened in farmyards, right to repair. The fight sounded like tractors and wrenches, but underneath it was the same IP logic as seeds. Manufacturers argued the software that runs modern machines is licensed, not owned, so only authorized dealers should access critical diagnostics. Farmers pushed back. If you can't fix your combine during harvest without a dealer's laptop, you don't really own it. Lawsuits landed. A memorandum between a farm lobby and a major manufacturer promised more access. Colorado passed a law. Elsewhere, progress was piecemeal. Even where access improved, it came with conditions. No circumventing safety features, no divulging trade secrets. Reasonable on paper. In practice, the gatekeeper stayed in charge. Dealers spread thin over huge territories still created delays. Independent techs lacked full tool sets. A week lost to a locked code is a season lost in farm math. The repair fight showed how IP can extend beyond seeds into every tool that touches them. Fixing a clause in one link leaves the others intact. Regulators know this, but jurisdiction fractures the field. Seeds cross borders, grain ships in days, financing flows in seconds. Antitrust is national, trade is global. One country's remedy can shift assets without widening choices. Labeling rules differ. Disclosure doesn't travel with bulk grain. A right to repair law in one state doesn't unlock a software license in another. Meanwhile, financial owners sit above it all with portfolios that straddle continents. Policy chases transactions, strategies jump fences. There's also time. Cases take years, seasons don't wait. While agencies build records, companies launch successor stacks, rewrite contracts, and close roll UPS. Even a strong decision fixes yesterday's overlap. Tomorrow's leverage sits in data platforms that predict flows, or in value-based clauses that read like quality programs but act like tolls. Courts want clear harms and clean remedies. Agriculture offers diffuse pain and entangled causes. The law prefers scalpels. The system resists surgery. A grocer in Ohio saw this from the last mile. State officials pressed for price transparency. The chain complied. The spreadsheets were tidy, cost increases documented, promos scheduled, margins within norms. Nothing illegal. Nothing simple. He could show a senator the freight surcharge and the flour roll date, and the co-op spend shrink. The senator nodded, then asked about price gouging. The answer was boring. Covenants, basis, resets, labels that don't move invoices. The meeting ended with a photo. The limits aren't a conspiracy, they're architecture. Antitrust narrows overlaps. Labeling informs. Right to repair loosens one lock. None of them, alone or together, unwind a model that monetizes risk and embeds royalties across a chain run by a few firms with cheap capital and good lawyers. Policy tends to aim at products. Power lives in pipelines. Farmer workarounds and open source seeds. If policy moves slowly, farmers move on Tuesday. The first workaround is scale, but shared. Co-ops that once meant bulk fuel now mean bulk leverage. In central Minnesota, 26 growers formed a buying group that negotiates seed and chem bundles across brands and pins rebates to transparent calendars. They also leased a unit train loader for harvest windows, cutting freight spreads by locking service days. The deal didn't break the system. It shaved nickels in places where nickels compound. Members agreed to deliver in staggered blocks. Margin calls were pooled and financed at the co-op's lower rate. One season later, members' per bushel carrying cost dropped enough to fund a modest grain cleaning line. Small, but it reopened a choice. Shared storage and hedging are the quiet backbone. A Kansas co-op-built community bins with aeration and quality testing, then offered pooled hedge-to-arrive contracts run by a risk committee of growers and one outside merchandiser. The committee didn't try to outguess markets. It set rules: ladder forward sales, cap exposure, keep cash available for margins, and publish weekly basis forecasts to members. When the river ran low, they widened delivery windows and paid trucking premiums out of a common fund instead of eating discounts in silence. The co-op lost less in bad weeks by removing panic from the pricing room. Workarounds also mean seeds that can move without a license shadowing every kernel. The open source seed initiative took a page from software. Release new varieties under a pledge that any downstream user can save, breed, and share. No patents, no restrictions. It sounds quaint until a drought exposes how brittle a region's genetics have become. In the upper Midwest, a small network of breeders and farmers multiplied an open-pollinated wheat tuned for shorter seasons and reliable protein. Yields weren't record-breaking, but milling quality held when heat domes hit. A craft mill signed a forward contract. A regional bakery agreed to segregate. A school district took the bread. That chain only worked because nobody had to call a licensing office to plant next year's seed. Regionally adapted varieties are the leverage point. A Montana grower working with a university extension trialed 3 open-source barleys across microclimates and found one that beat a common proprietary option in test weight during hot, dry harvests. He saved seed, traded with neighbors, and pooled trucking to a maltster who wanted variety-specific lots. The price wasn't a windfall, the risk was lower. When a neighboring elevator posted a trait-linked protein premium the open-source barley didn't qualify for, the malt contract, written with clarity on specs and timing, paid anyway. Options matter when platforms fail gracefully for someone else. Brands can help when they want something money can't buy. Provenance, that's true. A snack company piloted a regenerative contract with growers in 2 river basins. The offer: 3-year terms, soil testing paid by the brand, a baseline premium, and an inflation escalator tied to published input indices. No trait requirements beyond performance. Open source and conventional lines allowed with documented agronomy. The brand bought forward on a fixed-plus basis formula with narrow surge clauses. Farmers got predictable cash flow. The brand got a story and supply stability. It wasn't charity. It was a swap, data for duration. But every workaround has friction. Scale is the tax. Cleaning and segregating grain requires space, testing, and paperwork. Certifications, organic, regenerative, identity preserved, carry audit costs and learning curves. A co-op that invests in cleaning might find its local elevator quietly tightening acceptance windows to discourage volume leaving. A processor may agree to take open-source lots, but insist on truck appointment systems tuned to big suppliers, pushing small queues into night slots. When a regional bakery succeeds with open-source flour, a national brand may counter-program promotions, leaning on category captains to flood the shelf with limited-time sizes that soak up attention. Finance threatens workarounds with timing. A co-op can pool margin calls, but a brutal week still drains cash. A regenerative contract can stabilize price, but if a landlord raises rent on renewal, the premium becomes a pass-through. A university breeder can release a strong line, but without a seed company's distribution muscle, dealers stock it lightly. And IP finds new doors. Equipment software locks can slow harvests. Data platform terms can claim rights over yield maps that a grower hoped to share with an open-source breeding network. Still, small levers move bigger gears when aligned. A co-op's pooled hedging reduces volatility, just enough for a local credit union to offer a cheaper operating line. That cheaper line frees a farmer to hold grain 2 more weeks, hitting a mill premium. The premium encourages a second mill to post specs for open-source wheat, drawing in 2 more counties. A school district signs for the bread, parents talk, a grocer tests a local flour end cap. None of it breaks a patent. All of it builds an alternative path that doesn't pay a royalty simply to avoid risk. The people building these paths keep their heads down. They host potlucks where the agenda is trucking rates and clean-out protocols. They pass around spreadsheets that show how a 7-cent basis improvement funds a gravity table. They debug QR codes on lot tags at midnight before an audit. The wins aren't loud. They're sticky. Every season a farmer saves seed that works. Every contract that pays for resilience instead of exclusivity. Every pooled margin call that doesn't end a family's year. That's a receipt rewritten, 1 line at a time. The consumer trap and tiny levers that move markets. By the time prices reach a cart, it feels like all the decisions are already made. That's the trap. We're nudged to argue over brands while upstream fees hum along untouched. But there are levers, small, dull, reliable, that bend the arc more than they look. Start with unit price literacy. Not the big tag, the tiny one. Ounces, pounds, per 100 sheets. In commodity-linked goods, bread, cereal, cooking oil, promos hide behind pack changes and family size illusions. The only honest comparator is the unit tag in the corner. The Garcias started watching those numbers. They found a cereal deal that cost 7% more per ounce than last month's smaller box. They switched to a store brand that ran the same line at a lower per ounce. 1 cart won't move markets. 10,000 carts during a category reset will. Seasonality is another lever. Commodity-heavy items ride harvest calendars. Flour features often cluster after new crop. Oil discounts show up when crush runs peak. Households who shift pantry refills to those windows, even by 2 weeks, signal buyers that promotions work at lower list prices. Retailers redskin data like scripture. If enough baskets move in seasonal sync, planners allocate more end caps to lower-priced SKUs and fewer to the shrinkflated variants. The aisle changes when the calendar does. CSAs and local grain subscriptions sound boutique. They aren't when they aggregate. A small mill in the upper Midwest launched a monthly flour box at a steady price tied to regional wheat, not Gulf basis. 500 households signed up in a quarter, then 1,000. That volume funded longer contracts with open-source growers and paid for a second sifter. The effect was a pocket of demand insulated from long-only money's roll week, and a proof point that processors can price off local flows when volume is sticky. Stability is contagious when it's financed by subscribers, not wholesalers. Pressure points exist inside chains that look impermeable. Category resets happen on schedules. Retailers ask for feedback months ahead, even if they don't advertise it. Coordinated, boring emails from actual shoppers. Keep the 2-pound flour at this store. Stop replacing it with 1.5-pound value packs. Stack in a file. When a dozen stores in a region receive similar notes, captains adjust planograms to preserve the lower unit price anchors. It's not a petition. It's a trail of practical requests tied to specific SKUs in stores. Merchants want clean KPIs. Consumers can write them. There's leverage in who owns your retirement too. Pension funds and 401k. Vote proxies for companies that buy seeds, mills, warehouses, and land. Shareholder proposals on concentration, contract transparency, and value-based royalties sound abstract until a large fund backs them. When a public processor must disclose how trait-linked premiums roll into invoices, a retailer suddenly has grounds to push back on a surcharge. The disclosure doesn't cut prices tonight. It arms the next negotiation. The trap deepens when people think their only option is boycott. Boycotts flip volume to rivals who live in the same playbook. Smaller levers work better. Switch 2 items per trip to true generics with transparent unit prices. Buy the largest honest pack only when it beats per unit math. Choose private label in categories made by multiple processors, not one. Support the weird local product that shows up for 6 weeks and tells you who grew it. Those microvotes teach buyers what survives resets. Coordinated timing helps. A neighborhood group in San Antonio tested a simple tactic. For 1 month, they tracked and bulk texted each other when a particular store swapped a long-standing 32-ounce staple for a 28-ounce new size at the same price. 20 families filed feedback the same day. A few mentioned switching stores. 2 weeks later, that store restored the 32-ounce SKU in 2 locations. It wasn't a crusade. It was operational friction, cheap, specific, persistent. Local institutions can anchor demand without speeches. A charter school committed its cafeteria to a regional bread contract that used open-source wheat during the school year. A hospital group bid its cooking oil on a formula tied to a different benchmark than the usual index. Those contracts gave processors cover to sign steadier deals upstream. The public never saw the paperwork. They saw fewer temporary surcharge signs and a price that didn't yo-yo on payday. There's a pitfall in every lever. CSAs fail if pickups are hard. Local grains stall if mills can't meet food safety audits. Unit price hunting burns time families don't have. That's why tools matter. A mother in Fresno built a shared spreadsheet of true unit prices for 20 staples across 3 chains, updated monthly by 5 neighbors. It looked silly until it saved them $18 a week each without switching stores. The sheet traveled to a church group. 2 months later, a store manager called to ask why the house brand flour suddenly outsold the captain's core size. He didn't get a lecture. He got SKU numbers. Markets learn through pain or through patterns. Pain came from droughts and wars. Patterns can come from tiny, repeated choices that algorithms can't ignore. The aisle won't turn into a co-op overnight. But if enough shoppers move a few predictable levers, the people who set floors and ceilings feel a tug. In a system tuned to spreadsheets, the quietest pressure is the kind that shows up in cells. The clause, royalty on farm gate to retail. We've followed fees and surcharges, but one clause quietly ties the farm gate to your receipt. Value-based licensing with a royalty attached to quality. It starts at the elevator's probe. A load tests high on a trait-linked metric, protein in wheat, oil in soy, extract in barley. The test triggers a premium schedule. On that schedule, a slice belongs to the trait owner. Stakes are simple. If the trait actually lifts milling yield or crush value, everyone wants to capture it. The elevator posts a premium, but the fine print routes a few cents per bushel upstream as a license fee. The farmer sees a better check. The elevator books the rest as quality. The royalty leaves the county. What nobody sees on the scale ticket is how the premium spreads. A mill buys that wheat at basis plus quality, then converts bushels into flour with a higher extraction rate and a tighter spec. The mill is happy to pay because the flour runs smoother, scrap falls, and maintenance softens. But the invoice to the bakery now includes 2 lines: the premium itself and a program participation fee to cover audits, segregation, and the license that runs with the trait. Those lines aren't huge. They're repeatable. Here's how the math compounds. Take a 5-cent per bushel royalty tied to a trait in a wheat blend. At 60 pounds per bushel, it's roughly 0.083 cents per pound of grain. Milling yield turns that grain into flour, say 72% extraction. So the royalty becomes about 115 cents per pound of flour. Now add the mill's overhead for program compliance. Call it another 0.05 cents. The baker blends flour, sugar, oil, yeast, and time. By the time labor, energy, packaging, and shrink stack up, every upstream tenth of a cent has a multiplier. A bakery sees the all-in flour increase and raises dough cost per unit a fraction. Retail rounds to the nearest penny. Millions of loaves later, a tiny upstream royalty is a steady downstream drip. A Midwestern bakery learned this the hard way. Their flour contract rolled into a trait-linked premium after a summer of thin kernels. The mill made the case. This spec cuts downtime and improves consistency. Here's the schedule. The bakery agreed, betting the line would run cleaner. It did, but between the premium, the compliance fee, and diesel surcharges on inbound flour, the total added 7% to dough cost. The chain passed 7 cents to each sandwich loaf. No headline, no scandal, just a clause working as designed. Farmers aren't passive in this. Some chase the premium, manage protein with fertilization and timing, and hit contracts. Others try to avoid the trait program by blending or by delivering to an outlet that doesn't test. But processors move specs across regions, and elevators align with buyers. When the largest mill in a radius anchors on a trait-linked protein test, neighboring buyers harmonize. The optional program becomes the market. The legal scaffolding is careful. The royalty isn't a padlock on a bag of seed. It's a license on a measurable outcome. That's why it survives scrutiny. You're not paying for the gene, you're paying for performance. And yet, the gene owner wrote the test, set the ranges, and audits the chain. Enforcement shows up as friendly compliance at first, then as chargebacks if lots miss specs. The chilling effect is real. A mill that tries to source around the program risks losing access to a marketing claim or to a predictable flow. A bakery that opts out risks inconsistent flour that jams a high-speed line. Remember the subscription farm? The royalty is its cousin. One sells certainty in the field, the other sells certainty in the factory. Both shift risk into fees that don't evaporate when weather calms. And like the subscription, the royalty can restart its clock when patents age, combine the older trait with a new companion, certify a new spec, and extend the program. The clause doesn't care about birthdays. It cares about adoption. There's a small rebellion brewing in specialty channels. Craft mills post specs without trait branding and prove consistency through process, not genetics. Some brands pay a fixed plus basis price for open-source grains with audited handling and accept slightly wider variants. They trade a royalty for more storage cost and more attention. It works at small scale. The challenge is volume. National lines crave uniformity, and the clause sells it. Follow the money from the probe to the shelf, and the loop closes. Elevator to mill, premium plus license. Mill to bakery, program fee and tighter spec. Bakery to retailer, cost increase letter with quality improvements. Retailer to shopper, a penny or two that never goes back quietly. It's legal, common, and invisible. A seed company doesn't need to own a loaf to price it. A clause will do. Resolution and broader meaning. Control the gene, the gate, and the shelf, and you don't set one price. You set the range everyone else must live inside. Here's the move. Widen that range from below. Want the next chapter on water rights and cold storage monopolies? Watch our follow-up. Then pull 3 levers this week. Save and share this with one person who buys bread. Switch 2 staples using real unit prices, not the headline tag. Tell your store, SKU and aisle, to keep the honest size pack. If this helped, hit follow so you don't miss the next map of how money moves your dinner.